Hey, hi, this is Kirubakaran Rajendran. So in this video, we are going to talk about importance of rule-based trading. So before I explain what are the important points that you need to focus on creating a rule-based trading system, first we need to understand why rule-based trading is really important to become a successful trader. So trading should be treated just like any other business. So just like any business which has a proper business plan to succeed, trading should also have a proper business plan to succeed. So if you're doing trading because it gives you this adrenal rush whenever no market moves in your favor, or no, it excites you during no placing the trades or being in the markets, if it excites you, then soon you will burn out. So as soon as you start following a rule-based approach, then it gives you a peace of mind, it gives you a stress-free trading environment, and eventually you become a successful trader. So, as I always say, when there is a process, there will be a progress. So, by creating a rule based trading system, it clearly tells you when to enter the markets, when to exit the markets, where should you keep the stop loss precisely, and it also helps you to know how much is too much. As I always say, the successful trader are the ones who are able to sleep peacefully with their overnight positions. So only if you're a trader who is always checking what happens in the US markets or what is happening in the SGX markets in the next day, when the market opens. So if you keep observing the markets, what is happening because of your overnight positions, then it means that you are trading with a capital that you cannot afford to lose. So you have to reduce your risk and then you have to trade. So only then you would be able to succeed on the long run. So by creating rule-based trading system, it gives you clear-cut rules, a well-defined rules on what needs to be followed, what you need to do, and what you should not do. So let's start with what are the important points that you need to keep in mind when you are getting started with rule-based trading. So the first and foremost rule is drawdown. What is drawdown? See, drawdown is nothing but what is the movement that it has happened from peak to trough. So it means that, say, suppose you have invested 50,000 in the markets and your fund value grown from 50,000 to 1 lakh. So now you have made 100% returns so far. So the fund value reflected that you have made 100% because it moved from 50,000 to 1 lakh. Now, from 1 lakh, if it comes back to 50,000, if it start reducing to 50,000, which means that you have lost 50% of your, the fund value, which is nothing but the drawdown. So drawdown is nothing but a series of losses that could happen over a period of time. So people should not confuse drawdown with max risk per trade. So losing a money in one single day is not a drawdown. It is just a loss that happened in one single day. But a consecutive series of losses or a losses that happens over a period of time, that what you call it as drawdown. So in this example, when a fund value loses from 1 lakh to 50,000, that 50% is what you call it as drawdown. So when you create a trading system, you have to give utmost importance to drawdown because your overall success depends upon how much drawdown a particular trading system is giving. So based on that, you have to choose whether you have to get into the trading system or not. So lower the drawdown, much better it is because there is a higher chance that you will stick to the system if the drawdown is lower. Even though if the overall profit is much bigger, but if the drawdown is also not much bigger, then you will not be able to stick to the system. So it is very important to make sure whatever the trading strategies or rules that you are creating, make sure that the drawdown is very minimal. And there is a ratio called overall returns, total returns generated by a trading system divided by this maximum drawdown value. So higher this ratio, better it is. So the next one is time drawdown. So the earlier one that we have seen is price drawdown. So this one is time drawdown. So the difference between these two is price drawdown, anyways, we know like this is the percentage of loss or worst case scenario that could happen based on the historical results. Time drawdown is nothing but how many number of days the equity is underwater, which means that how many number of days your trading system is not performing well decides the time drawdown. So what happens is when you are trading with the systems like breakout trading systems or trend following systems, these kind of systems makes profit once in a while and most of the time it will be in drawdown. And when you are trading with these kind of trading systems, you need to make sure that you are able to adapt to these systems because as systems like trend following or breakout can be in underwater, can perform poorly for a very prolonged period of time, 3 months, 4 months, or even for 5 months. It might not make any profits at all. So when you are creating a rule-based trading system, you have to find out how many days a particular trading system is not making profits or how many days it is underwater. So there is another ratio that you need to give importance to it. What is the ratio is? Say suppose you have backtested a trading strategy for 5 years or 1 year, whatever that is. Say suppose you have backtested it for 1 year. Now your trading system, which you have tested for this 1 year is, the maximum drawdown days. If it is 10 days, then what you have to do is, in this 1 year, the total number of trading days is 252 trading days. So your number of days, your trading system, which was in drawdown, was 10 days. So now divide this 252 trading days, the overall number of trading days in a year, divided by this number of days where your system is underwater, which is 10 days. So 252 by 10, which is 25.2. So this ratio. So higher this ratio, better it is, which signifies that your system is basically underwater for a lesser period of time. So when you are creating a rule-based trading system or trading strategies, make sure the time drawdown is relatively lot lesser. So the next one that we are going to see is instrument. What is the instrument that you're going to trade with? So as a beginner who are getting started with rule-based trading, I would advise you to get started with Nifty or Bank Nifty index compared to stocks. Because when you are trading or trying to create a trading system based out of stocks, not only you need to figure out when to enter and when to exit, you also need to figure out what are the list of stocks that you wanted to trade with. So creating a list of stocks, it comparatively is a lot tougher than trading with index, because say suppose if you wanted to trade with a list of stocks that are part of Nifty 50 currently, then you need to figure out where the list of stocks that were part of Nifty 50 5 years or 10 years before. And finding these information is not so easy, and it takes a lot of time and effort. Whereas if you're trading with Nifty or Bank Nifty, then you don't need to worry about these things, like figuring out what was the was there any bonus given, or was there any dividends given, was there any stock split that happened. So finding all this information in stocks is a lot difficult than index. And second thing, when you are now trying to create a trading system, even for instruments, try to avoid instruments initially like FinNifty, where the liquidity is not so high compared to Nifty or Bank Nifty. So find out what kind of instrument that you wanted to trade. So as a beginner, I would recommend you to stick to Nifty index or Bank Nifty index compared to any other indices, and avoid trading with stocks or creating rule-based trading system with stocks during your initial period, because backtesting is a lot easier with respect to index. With respect to stocks, it becomes a lot more tougher. So that is why choose the index wisely, and then from there start creating your rule-based trading system. And the next one is choosing whether you want to trade with intraday or positional. So how it is really important is, say suppose you are a working professional who has his day job between 9 to 6 in the morning. So in this case, if you are going to trade an intraday trading based system, then it would be really difficult for you to manage your work as well as manage your trading, because you need to monitor the charts and you need to constantly see what is happening in the markets to make money with the intraday trading, unless you automate it. So what happens is, it consumes your time with respect to trading, as well as it consumes your a lot of time with respect to work also. So eventually it would affect both your career as well as trading performance. So you need to find out what suits you. So if you're a working professional, it's better to stick to a positional trading system at the beginning stage, and then slowly move to an intraday trading system, which requires lesser time monitoring systems, or which requires less time and effort with respect to the trading systems that you create. So you need to find out what suits you. So find out what kind of person you are, whether you are a person who has to spend a lot of time and effort with respect to your day-to-day job. If so, then do not start with intraday system. Slowly start with positional system, or do not start with intraday system, which takes a lot of effort for you to sit and monitor the charts and then make decisions. Create system in such a way that your screen time is lot lesser, so that you don't need to sit in front of a system between 9 to 3 in order to make profit. So there are certain trading strategies which you can deploy in the morning and then check out in the evening. So if you're trading that kind of system, then it's really well and good. Otherwise, it's better to stick to positional trading system if you are a working professional. So with respect to emotions, so most people are not able to make profits, or most people do mistakes because of their emotional imbalance with respect to trading. Whereas when you get started with rule-based trading, or when you're sticking to rule-based trading, emotions will not be removed completely, but it can be greatly controlled. So the number of errors that you tend to do being a discretionary trader or being a non-rule-based trader slowly starts decreasing once you adapt to a rule-based trading. Because if you look back your own trading history, check when was the maximum loss that has happened. If you look closely, you will figure out that whenever you tend to panic, the maximum loss has happened. And when did you tend to panic is because probably when the market suddenly went down after you purchased a stock, and you were not able to react to it because you are not prepared for it. When you're not prepared, you tend to panic and you tend to make wrong decisions. This is when the rule based trading comes and helps you, because it precisely tells you exactly when to exit before even when you enter. So you know exactly what should be the stop loss, what should be the quantity that you need to buy, where should you enter, and where should you exit. So when everything is predetermined completely, you will not panic. Wherever the market goes, you have your rules in hand, so accordingly you're going to take decisions, and this greatly helps you to control the emotion. So when the emotions are controlled like to this kind of great extent, you tend to do very less mistakes, and eventually this helps you to become profitable on the long run. So to conclude, so I would definitely recommend you to get started with rule-based trading. So start creating your own rules. Do not trade randomly. Whatever it is, even if it is a small trading system, create your own trading rules, create your own trading strategy. Try to backtest it with various platforms like StockMark or AlgoTest, to check how your trading system would have performed historically. This gives you a conviction, okay, historically, if your trading system has worked in the past, then it could work in the future. So a backtest gives you a conviction to stick to a trading system. And second thing is, okay, you have created a trading strategy, you have backtested it. Now what you need to do? So now what you need to do is, do not deploy whatever capital that you have and start trading that system. Instead, trade with only one lot, at least for 100 days. Because even though you have enough capital to trade multiple lots, I recommend you to trade with only one lot for 100 days to check whether you are a disciplined trader or not. Because for the next 100 days, whatever the trading rule says, just follow it. And just keep a trading journal, and next to every date, mention whether you have followed the rules or not. If you have followed the rules, say suppose in today's date, I'll mention today's date, and today I've created a trading strategy and I'm following a trading strategy. And if I am following the rules as per trading strategy, I myself will give 1 mark to me. If I'm overriding the rules, if I'm not following a trading strategy because of my emotions or because of any news factors, I'm trying to override my rules, then I'll give -2 mark. So likewise, for the next 100 days, just check your trading journal and give marks to yourself and see how much you scored after 100 days. So when you're right, give 1 mark. When you're wrong, give -2 mark. Or when you're not following the rules, give -2 mark. So this way, after 100 days, go and check your overall score. If your overall score is greater than 90, which means that you are very disciplined trader first, because you're not overriding the rules. And second thing, when you're not overriding the rules, eventually profit will follow. So if you're not making greater than 90 score, I would suggest you to keep repeating the exercise with same one lot, unless and until you score greater than 90 marks. So the moment you do it, then you will realize, okay, for 100 days, I have followed a trading strategy. This will give me conviction. And second thing is, you will know how your trading strategy has performed when market moves up, or when market moves down, or during sideways, or if it is volatile or non-volatile. So during this 100 days, most of the periods would be covered. So you know exactly how your system performs. And then if you scale up your capital, there is a higher chance that you will stick to it. So being a successful trader or becoming a successful trader, it's all about being disciplined with the trading system. So once you have a trading rules or trading strategy, just follow it diligently and you would eventually become a profitable trader. So this is what I wanted to convey in this video. Please post, if you have any questions, please post it in the comment section. I'll address it. Next time we'll come up with a different topic and we'll see you guys. Thank you. Bye.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.